We just got news out that Access Kenya's first half results have come out, profit after tax doubling to 62 million shillings, earnings per share also doubling to 30 cents per share. That stock has been under considerable pressure this year. Let's take a look at the thoughts from our Nairobi broker this morning on what he thinks of the results coming out of that company and earnings potential going forward. Samuel Gichohi, research analyst at NIC Securities. Samuel, I'm not sure if you've had a look at these results. They've just been released, but we're seeing profit after tax, as I say, doubling to 62 million shares. Revenues are slightly up for the company as a result of growth in the internet division, but IT sales have been under pressure there. We know the stock has been falling in 2011, underperforming the overall NSE 20. What are your thoughts on Access?
Well, it's a good thing for them to, 100% increase in profit, and we've seen their margin, the profit margin also double. But I still think they're still under pressure. We have some of the big boys getting into data and getting into internet service provision, and that is still quite a bit of pressure on them. Their cost of sales has also gone down, meaning that they have been more efficient over the year. And well, it is a good sign for investors who have been waiting with bated breath to at least see some recovery in terms of the earnings on Access Kenya front. And the company has actually, if they continue with this sort of trend, will probably be perceived to have weathered the storm. But I still believe there is still a lot more to come, considering that the data space is still growing and still there's still a lot of very, very strong entrants in the market.
We have to take a look at what's happening with the weakening spree that we're seeing on the shilling. It toppled a 17-year low yesterday of 90, just over 92 to the dollar. Traders now saying the technicals look very poor. Is 100 in sight?
Well, I won't go that far, but I still think that, well, if anything has gone wrong, it has gone wrong. And we have had a lot of pressure on the shilling. Our import bill is escalating. As you know, Kenya is actually the hub. And with all this famine in all the neighboring countries, then all the supply has to come through here, and it is quite a bit of a burden for the country, especially in these times of a bit of economical pressure. So I believe that we are hoping that there could be a sort of recess from these issues that are hitting us, one after the other. But I do believe that we can weather the storm going forward, and the economy has proved resilient in the past, and I believe we still have the power to do so.
So Samuel, what are your favorite stocks at the moment, given the fact that we've had this general bearish trend this year?
Well, I think at the moment, the Nairobi Stock Exchange is offering huge bargain opportunities. I think with most stocks trading at around 10 PE ratio, they are the pricing is quite low, and I think the interesting thing is we are still in a situation of double-digit growth on most companies, and if you look at the financial sector.
I mean, do you see a disconnect between what's happening in the macro operating environment with the weakening shilling and interest rates, and then the results that we're seeing coming through from the companies, which have seemed to be better than expected?
Yes, a very interesting disconnect, because we look at the banking sector and we are seeing them, they're still lending very heavily. They're still making a lot from, increasing their loan books heavily, meaning there is still quite a substantial level of investment in the country. We are still seeing a lot of activity on the market. The boss has lost so much, yet if you look at the situation we are in now, we are actually in an IPO window opening, in a period where most other markets would be considering going back towards the bonds market. But then again, the bonds yields have gone up, and that has also been hit hard, and with very low turnover on the bonds secondary market. So I think there are a lot of mixed signals at the moment, and for an investor who's looking at our market, I believe now would be the time to take positions and wait it out, because I do not see the market going down much further.
Which stocks could you then pick up at cheap prices at the moment?
Well, at the moment, I would be buying those that are giving me the most growth opportunity. I feel my favorites at the moment are Athi River Mining, Equity Bank, Kenol Kobil, Cooperative Bank, and Kenya Commercial Bank. Those are the ones that I feel are giving the best opportunities for growth going forward. They have continued the expansion strategies very, very aggressively, and they have continued to show that they know what they're doing, and they are able to even take a price war, for example, in the case of Athi River Mining. So I believe that, and Kenol Kobil has actually been eating into the market share of their competitor Total. Athi River Mining has been eating into the market share of Bamburi and the other big competitors. So I think we still have quite a few stocks out there that are offering very strong growth opportunities.
How's Athi River Mining handling the competition that we're seeing from cement importers and then perhaps from cement makers on the other side of the continent? Because we have the likes of Dangote Cement, very aggressive plans on the region, and on the continent as a whole. Is this company going to be able to sustain a heightened competition?
I think they are able to do so. The first thing is that the infrastructure on the ground makes it difficult to get the cement to the market. And so in as much as the cement might land at port at slightly lower prices than Athi River Mining might be able to manufacture it, then by the time it gets to market, then it has already gained in price, and therefore Athi River Mining can compete. And Athi River Mining is also doing most of their clinker production, actually 100% of the clinker production themselves, so they're no longer relying on Bamburi cement or imports for that. And they also have a bit of a regional footprint, which gives them some more diversification across the region. And so this also offers them more cheaper cost to get to market. They also have diversification of product, which means at the same time they are able to leverage on management costs, because then they can get more income streams from, with less cost.
If you're an investor looking for stocks with strong dividend streams, where would you suggest someone puts their money?
Well, for dividends, you find that I would be going for the more defensive counters, and Nation Media, Barclays Bank. I would be looking at somebody like BAT with 100% dividend payout policy. So I would be looking at the more defensive, those that already have their market share and tend not to have huge fluctuations in difficult times. But I don't know, the fact that, again, I come back to the fact that we are seeing mixed signals. The growth stocks and the growth companies are still showing very strong growth and underlying growth. So I would still be betting on growth rather than betting on an economic slowdown. So I would be staying with the growth and with more risk rather than going defensive at the moment.